Imagine waking up to the news that the United States and Israel have launched coordinated strikes on targets inside Iran. Missiles are exchanged across the region. Energy infrastructure is disrupted. Oil prices spike before most people have even finished their morning coffee. And within minutes, the same question begins circulating across financial markets. Is this a short-term geopolitical shock, or the start of something that reshapes the global economy? Because when tensions rise in the Middle East, it doesn't stay a regional story for very long. Energy markets move first, then inflation expectations, then interest rates, and eventually your investments. So today, let's walk through what's actually happening, why markets react the way they do, and what it might mean for ordinary investors here in the UK. The immediate market reaction. When geopolitical conflict suddenly escalates, markets tend to react in two phases. The first phase is automatic. Algorithms trigger, risk models update. Large funds reduce exposure to equities. Money moves quickly into assets perceived as safer. Things like government bonds, gold, or the US dollar. We saw that almost immediately. Oil prices jumped sharply. Natural gas climbed. Gold moved higher. Stock futures fell before the US market even opened. On the surface, it looked like the beginning of a broad sell-off. But then, something interesting happened. By the end of the trading session, markets had stabilised. Some indexes even recovered most of their early losses. That pattern isn't unusual, because after the initial shock, investors begin asking a much more practical question. Is this disruption temporary? Or is it going to meaningfully affect the global economy? The real issue, energy. The answer usually depends on one thing. Energy. Short-lived geopolitical events tend to create brief volatility in market, but sustained disruptions to oil and gas supply can ripple through the entire global economy. And that's why the Middle East matters so much. Roughly a fifth of the world's oil supply passes through the Strait of Hormuz, a narrow shipping route between Iran and Oman. If activity there slows or becomes uncertain, energy markets react quickly. Even small disruptions can push prices higher. And energy costs don't just affect petrol stations. They affect almost everything. Fuel powers transport. Transport moves food, materials and goods. Businesses pass those costs on to consumers. This is how a conflict thousands of miles away can eventually show up in your weekly shop. Why investors are watching inflation? Over the past year, inflation had been gradually easing across many developed economies, including the UK. Central banks have been signalling that interest rate cuts might arrive later this year if inflation continued to cool, but energy shocks complicate that picture. If oil and gas prices remain elevated for several months, inflation can become stickier than expected. And when inflation stays high, central banks tend to delay cutting interest rates. That matters because borrowing costs affect almost everything in the economy. Mortgage rates, business investment, credit card interest, car finance. If energy prices remain high long enough, the timeline for lower interest rates may shift further into the future. How this shows up in your investments. When markets become uncertain, different sectors react in different ways. Energy companies often perform relatively well when oil prices rise. Defence stocks sometimes benefit from the increased geopolitical tension, but industries that rely heavily on fuel, like airlines, transport and logistics, can come under pressure. That's why your pension or investment account might suddenly feel more volatile. Even a 1% or 2% move in the market can feel significant when headlines are constant. But it's important to remember something. Volatility is the market adjusting to new information. It's not necessarily a signal that long-term trends have changed. Historically, many geopolitical shocks cause sharp but temporary market movements. Once the scale of the disruption becomes clearer, markets tend to stabilise. The bigger economic question. The real question investors are trying to answer right now is simple. Will this remain a short-term disruption? Or will energy prices stay elevated long enough to slow economic growth? If oil stabilises quickly, the global economy can absorb the shock. But if energy costs stay high for months, it can create a more difficult environment. Higher inflation, slower growth, and potentially tighter financial conditions. Economists sometimes refer to this combination as stagflation, slow growth paired with persistent inflation. That scenario isn't inevitable. And today's economy is very different from the oil shock era of the 1970s, but prolonged energy disruptions can still create similar pressures. Why discipline matters for investors. For long-term investors, the biggest risk during periods like this usually isn't the market itself. It's reaction. Watching your portfolio fluctuate while news alerts keep appearing on your phone can create a powerful urge to act. But markets often move faster than emotions can process. Selling during sudden drops can lock in losses that might reverse within days or weeks. Temporary volatility becomes permanent damage only when decisions are made in panic. That's why experienced investors focus less on predicting every geopolitical event and more on building portfolios that can withstand uncertainty. Diversification, long-term time horizons, and maintaining liquidity for unexpected expenses. These principles matter far more than trying to anticipate the next headline. Why this matters for everyday households. Even if you don't follow financial markets closely, events like this can still affect everyday life. Energy prices influence transport costs. Transport costs affect food prices. Higher inflation can delay interest rate cuts, and that feeds into mortgage rates and borrowing costs across the economy. The global system is deeply interconnected. A disruption in one part of the world rarely stays contained there, but the objective for investors isn't predicting every ripple. It's building financial resilience so temporary shocks don't become long-term setbacks. The long-term perspective. Geopolitical tensions have appeared many times throughout modern financial history. Wars, oil shocks, political crises. Yet despite those disruptions, global markets have continued growing over long periods. That doesn't mean volatility disappears. It means the long-term trend has historically been driven by economic productivity, innovation, and population growth. Markets adjust, economies adapt, energy systems evolve. But disciplined investors tend to focus on what they can control rather than reacting to every external event. Preparation matters more than prediction. Structure matters more than headlines. And the ability to stay patient during uncertainty is often what separates long-term investors from short-term traders. If you found this useful, consider subscribing to Budget and Build. This channel focuses on understanding money, investing, and building long-term financial security without hype or speculation. Because the goal isn't reacting to every headline, it's building a financial life that can survive them.